Hi, do you market buy options on Deribit? If so, stay tuned because this video will show you the method which will save you some money. Please give me a thumbs up and have a look at the links in the description below, which will give you fee discounts. So the major issue with trading options on Deribit are the spreads. The spreads can be massive. Starting with the short expiry options, like the one expiring in 1 day. If you want to buy, you pay 195. If you want to sell, you get 122. That's around 30% spread. Even on some more liquid options, like the one expiring on 26th of June, when a lot of futures expire, if you want to buy this option with $26 strike, you pay $12.63, and if you want to sell, you get $11.77. So that's around 10% spread almost. That's again massive. Now, what can you do to get a better price? I've recently went on a buying spree for long-dated December expiry, and a lot of these options are quite illiquid. I was keen in the money. I was keen on the in the money options, which had rather higher implied volatility than the at the money options, and they also had massive spreads. You can see that these options have, that is $14 spread, well, $13 spread. So these spreads are absolutely massive. Your implied volatility, if you want to buy, is 91.4, and if you want to sell, it's 62.1. So that's pretty much unacceptable. And the same goes for even shorter expiry date options. If you're looking for deep in the money options or deep out of the money options, you are going to pay a premium if you market buy. However, the way to go around this is to submit an option, submit an order on the option with the complex form. So you press complex order form and you can just press implied volatility. Now these should move around. So we're looking at 31st of July 320 strike option, and this option has a mark price implied volatility of 80.4%. The way I go around this is I start just below the mark price. Usually nobody buys, so I start with the smallest possible amount, and then I just gradually move up. So if the mark price here is 80.4, I would submit one order for 0.1 at 80.2, then the next one which would give me the slightly higher price, so 80.2 is 0.0405. So I'll just submit the next one at 80.4 implied volatility, another one here, another one there, and I'll just see at what price the market maker is keen to take liquidity from me. So at what price I am getting a fill from the market maker. Now this process can sometimes take a while, so if you are in a rush, you need to probably be more aggressive with the price. But my understanding from my kind of DIY at home reverse engineering is that it's not a completely automated bot that gives you these rather decent fills. I assume that there is a system which just flags all the good offers to some humans sitting in front of computers, and it's for them to manually approve some of these offers, to approve filling some of users' offers. So in my experience, you can sometimes wait for like 10 minutes, 5 minutes, 20 minutes, maybe half an hour. So leave these orders at the implied volatility that is of your interest and see where do you get the fills. And usually the fills are just above the mark price. So even though on the contract for example, 25th of December, so even though the best ask that you can find on this $180 expiry option is $94 or 87 implied volatility of 87%. If you submit implied volatility order at 78.2%, you might get a fill. You might have to go maybe 1% up to 79%. But I am convinced that at 79% you will get a fill without a very long wait. But that's a massive improvement over buying this option at 87%. So you can see that 87% is $94 for the option. But if you go just above the implied volatility, where I think you will get a fill, let's switch to 79% implied volatility. Rather than paying $94.59, you're paying $90.33. So that is how I recommend buying options, and the same goes for the puts. You're not only taking advantage of the market makers who are there at any point of the day, probably just manually approving what the system shows them, but you are also showing that you are buying the option above the mark price, and I don't see any options here flagged as attractive prices. But when you submit an option with the price, so if you want to buy with the price above the implied volatility or sell with the price below the implied volatility for the mark price of that contract, your offer is in red or in green, and that just draws attention, and some humans, some speculators or gamblers might decide to take your liquidity to give you a fill based on your attractive price that you have submitted. I think this is slightly in line of how many firms operate. For example, Alameda Research describes themselves as kind of DJs kind of navigating or showing the bots how to behave. So probably the bots flag the opportunities and ask for permissions to do stuff, and then the traders approve or reject what the computer proposes. So I think this is what happens here. I think there are some market makers which are quoting these rather ridiculous prices, but if you keep your order for a short while, it will probably get flagged to someone, and he'll likely approve your he'll likely approve his bot taking liquidity from you. I hope you enjoyed the video. Please give me a thumbs up, comment, subscribe. Please have a look at the links in the description below, which give you fee discounts. So if you register a new account on Deribit with a new email, you'll get a fee discount. It's a 10% fee discount on Deribit, and this applies to the options, and the options fees are ridiculously high, and that will save you some money.